Oh, good to be with you. It's Mark Albert here, and today we're going to talk about paying down our mortgage faster than what we normally would if we did nothing but make the payments. So we're going to focus on a fixed rate mortgage, so a 5-year term. People who like to do those, more people like to do a 5-year fixed term than a 5-year variable rate. I think it's because they feel more comfortable, peace of mind, fixed. They can budget. They know their numbers. Variable rate mortgage, it depends. It'll go up and down depending on the Bank of Canada's rate announcement. So every 8 times a year, the Bank of Canada, they will make a rate announcement. So that impacts the overnight lending rate. So if the overnight lending rate goes up, then your 5-year variable rate mortgage goes up. If their Bank of Canada's rate goes down, yours goes down. But we're going to focus on a 5-year fixed rate, okay? And what we're going to do is we're actually going to go onto one of my websites. It's called markalbertmortgages.ca, and I just basically want to give you a tool that you can use on your own. So let's say you're husband and wife, you're both on title, and you want to be able to pay down your mortgage quicker. This is what you got to do. This is how you think through the numbers, okay? I'm just going to show you a few illustrations so you know how to do it, and then you go do it whenever you want. So right here, you go to calculator, we'll click calculator, click here, and then there's 6 calculators. So the one I use for pay down is over here. So mortgage payoff on the bottom right. So click on that. I pre-populated most of it, okay? So what we're going to do is when you pay extra money, all that extra money beyond your normal payment goes directly to the principal of the mortgage. And it basically eliminates principal and any interest that was actually directly attached to the principal, okay? So we're going to say we got monthly payments. You could pick if you got semi-monthly or bi-weekly, but we're going to, for our illustrations, we're going to pick monthly. The mortgage is amortized over 25 years. That means that 25 years from now, the balance will be $0. Years remaining, we'll say 25 years, you're just starting the mortgage. We'll say it's a $500,000 mortgage. You can change the numbers as you wish. The interest rate, I went 3.79%. Now, granted, that's not a great rate right now, but a year and a half ago, that was a pretty good rate in the market for a 5-year fixed. And we're going to show you, you're going to make additional payments. So you could go yearly, you could go monthly. So that means that, let's say you do $2,000 a month, you can put money on top of that. These 5-year fixed rate mortgage contracts that you get with an A lender or B lender, they all have either you could do a one-time lump sum per year option, or you could put a little extra down on top of your monthly mortgage payment. If you go with that one, you got to make sure that you're allowed to decrease at any time if you all of a sudden money's tight and you can't maintain the higher monthly payment. But if you do that, you may not be able to go back up again on a monthly. So you can't just keep going up and down on a monthly if you're putting extra, okay? So I often talk about a yearly annual review with a husband and wife or whoever's on title. Let's just say you could put $5,000 down extra every year, okay? We're going to calculate that. And we see if you put $5,000 a year, you will decrease your mortgage by 5.3%. So just under 20 years instead of 25 years to pay it down. And then you got information here, a little bit something going on here. You can read that over, a little chart for those who want like nice and pretty. But I like to show, we're going to view the report, okay? So the report here, I'm going to jump down. So there's 6 columns, okay? This first column is your normal payment without anything extra, okay? Your second column is the interest on the payment, interest paid on that payment. This is an annual, so this is over the year. So this is just a snapshot of not your monthly, but of the total year, how much gets paid. So at the end of 1 year, your $500,000 mortgage is going to decrease to $487,000. But if you added that extra $5,000 to the principal, the payment goes to $35,000 for the whole year versus $30,000. And then your interest remains the same, a little bit lower though, but you'll see that your total, the balance at the end of your 1 year is lower, as 482,000 versus 487. It really makes a difference from year to year. Let's say after 5 years, your mortgage balance is going to be 433 versus 405,000 if you do 5,000. And so it pays it down significantly. And the amount of interest you'll see is more in your favor every time, right? So then if you go down to the bottom, just by putting $5,000, you've paid down in less than the balance in less than 5 years, okay? So let me go back to this here. So let's say you do really well and you want to do $10,000 a year, okay? So you do $10,000 a year, and instead of it being paid off in 5.3 years quicker, it's 8.8 years quicker, all right? Now, if we go back to review report, and if you just went 5 years, you'll see that your balance, instead of it being 433,000 at the end of 5 years, it's 377,000. So if you take this, we're going to evaluate 1 year at a time concept with your spouse. And then after 5 years, your income changes. You can't dump in that much money. At least look at the difference in 5 years. You instead of 433, you're at 375 in terms of balance. So that's pretty cool. All right, so you could do that. You could also do, let's say, you get an inheritance. All right, and you get a one-time amount, or you get a big bonus at work. Let's say you get an inheritance, and all of a sudden, in your first year of your mortgage, and you put $75,000 down on the mortgage. We're going to calculate that. That means you're going to pay it off in 5.5 years earlier. Now, what I like is you're accelerating your savings by $97,000 here just by dumping in 75,000. So if we go to report, and we take a look here, we notice that the ending balance is decreased significantly, but then over the long term, we see we're paid off. So you can look at that report on your own. I just wanted to share that with us, and I trust this is helpful to you. Play around with the numbers. It's a tool for you to use. One spouse, right? Usually husband and wife, one of the spouses, they're like into the money, into the numbers. They typically do the budget. The other one might not be into those things so much. So if one of the two spouses says, well, I'm going to play with the numbers, and then you could talk to your other spouse saying, hey, do we want to pay down the debt? You know, it's good to drive down debt because the quicker you get debt free, the more that frees up your ability to build wealth in other areas and other ways, right? The more you pay down your mortgage, the more you own, the more equity you own in that house. So that has a positive impact on your net worth as well. Listen, I trust this was helpful. It's good to be with you as always. Much success to you, and I look forward to talking to you again soon. Take care.